Good afternoon, everybody. Thanks for joining today. Thanks for taking the time. I know everybody's busy. I knew this was going to be a very popular as well as timely topic with regards to the presidential elections. We are coming in with about 2 weeks left until the elections. And it seems that not only that, but the coronavirus and the vaccine, as well as the stimulus, are really controlling the direction of the markets. And during presidential election cycles, the volatility of the market can tend to pick up because of so much uncertainty. Who's going to win the House? Who's going to win the Senate? Who's going to be sitting in the Oval Office? So what we wanted to do today is kind of remove the biases of politics out of this conversation and just focus kind of on the fundamentals of policy that have currently been proposed, as well as where we see the president or who the president's going to be come next January. So without further ado, we're going to get right into it. And before I get into it, I kind of wanted to go over where the current polls are right now. And one interesting point that I find compared to 2016. So Biden right now has about a 6 to 7 point, Vice Presidential Biden has a 6 to 7 point lead according to the Real Clear Politics poll, which basically takes the national averages of all the various polls and puts it into one concise number. And for those of you who didn't know, on 10/18/2016, that was the exact same lead that Hillary Clinton had over then presidential candidate Trump. So about 6 to 7 points. It's the same as what it was about 4 years ago, even though she had a much more commanding lead at the first part of October and obviously earlier than that. So we'll see how it narrows in over the next 2 weeks. Obviously, each candidate is on the trail, spending countless hours trying to determine which swing states they need to focus on most, which we'll go over here in a little bit as well. So the election timeline is basically laid out in front of us, and the path to election, in our opinion, contains events that could change the likely outcome. Now, we do know that early voting has already started. Some people have already mailed in their votes. I read a number up to about 2 million people so far. It's probably increased because that was last week. And in our minds, the majority of people who are going to vote, I would assume probably 90% of the people who are going to vote have already made up their mind. So it's that 10% of undecided voters that these two candidates are really thriving for. Obviously, we have the presidential election on the 22nd. That's the final one where we kind of get to see them go toe to toe again. Hopefully it's a little bit more civil and we get to see an actual concise discussion of actual policy at that final presidential debate. Then November the 3rd is the election day. Now, for a lot of people that didn't know this, the Electoral College meets and they don't formally cast their votes until 12/14. And then the Senate tallies up those votes on 1/6, and then obviously Inauguration Day, January 20th. But there's that pretty big gap between 11/3 and 12/14, as well as 11/3 to January the 6th, where a lot of people are talking about potential contentious election. And I'll go over that in here in just a minute, discussing what kind of happened during Bush v. Gore and what happened to the market during that period of time. But in reality, you know, what the market's saying is what we kind of put a particular focus on, because it's easy to get lost in the translation of potential policies or how that may play out within some form of a political sphere of an environment of the next 4 years. But we really do focus on kind of what the markets are telling us as far as direction on where we want to be in clients' portfolios. And the odds have really fluctuated. And since, you know, basically the early part of July have really started to narrow with, you know, Biden still holding a lead over the current President Trump, according to kind of where Wall Street's placing their underlying bets on. But what is important is obviously the economy. And the economy has historically been a very good indicator of whether an incumbent president will be reelected. And if you look back since 1932 or the Hoover administration, you can see that if there had been a recession in the preceding 2 years, that historically indicated a change in the Oval Office. So you can see President Hoover, there was a recession during his term. Ford, Carter, George Bush Sr., as well as Trump, with obviously the question mark. But you can see any president that has really run into some form of a recession in their, during the final 2 years of at least one term, very rarely gets reelected. And the reason for that is basically approval ratings, right? Typically during a recession, you see these deep tranches, massive amounts of unemployment, as well as massive amounts of layoff and disgruntled workers. Well, if you have people that really don't approve of the direction of the economy, then it's hard to really get their votes or have them show up for you based off of what's happened. Now, what I will point out is that this time, it wasn't something that was financially induced that has caused the recession. If you think back to 2008, which was the financial crisis, during the mortgage debacle, CMSs or mortgage-backed securities, MBSs. And this time it's really a pandemic-driven recession. And you can kind of see that from where the foundation of the recovery is right now, from where it was, let's say, in April or May, and the strength of that foundation from then until now, based off of unemployment coming down from about 16% now to below 8%. It's a pretty remarkable recovery. This is also the first recession that we've actually seen consumer savings increase during a recession. So don't let this recession, which we may have a high chance of getting out of by the end of October when they report that third quarter GDP. Remember, a recession is technically defined as 2 back-to-back quarters of negative GDP growth. We had one in the first and second quarter, but this third quarter could be one of the biggest GDP growth numbers in US history, just based off of that recovery speed, as well as the strength of that foundation of the economy prior to the pandemic taking hold of the United States. So don't let this one chart, give you one clear direction on who's going to be the winner, but the odds, according to this statistic, are stacked against Trump going into election day. Now, in addition to the economy, obviously approval ratings matter, right? So does the US approve of what you're doing? And what this chart looks at is it goes back to Harry Truman, and it tells you if they won or lost the election. Won is obviously in the dark blue and lost is in the light blue. But approval ratings of greater than 45% have historically led to re-election. But obviously history is ambiguous at a 40 to 45% level. And that's kind of right where Trump is right now. He's at about 45 or 46 as of yesterday. This is as of September. But you can see approval ratings are an extremely important component to re-election because that kind of gives you an idea of how your job's been going. You can see George Bush Sr. as well as Carter and Ford also during recessions did not get reelected, and you can see their approval ratings were below 40% for the majority of them during that period of time. Now, the candidate who has the most cash doesn't always win, but it is important, at least during the final stretches of the election campaign, on having enough capital to be able to produce enough content or spend on events in order to drive potential votes, despite the fact that it's our opinion that about 90% of people who are going to vote have already made up their mind on who they're going to vote for. So it's really targeting that last 10% or maybe flipping a few one way or the other. But here's a snapshot of the financial resources. You can see the Trump campaign has raised about $1.3 billion. Biden campaign not far behind it, $990 million. And as of the end of September, the Trump campaign had about $325 million left over compared to the $466 cash on hand for Biden, which may give him a slight edge in advertising spend. The one thing I will say about this is I'm sure everybody that's listening today is going to be happy, regardless of the outcome, to not see as many political ads on TV. I know I will be. Now, this is really something that I want everyone to pay particular attention to. It's really the issues and focus that really may determine the outcome of the election. So this is from Gallup, and this was done in about mid-June to the end of June. And it talks about the public opinion on the most important problems facing the United States. All the way in the bottom, though, is environmental pollution and climate change, only 2% of individuals. Now, this may be a reflection because we were in the height of the pandemic, and then obviously the riots and the items that were happening across the various police departments in the United States. But what's interesting to me is the environment, pollution, and climate change was the last. Unemployment and jobs only mattered 5%. The top three things were basically dissatisfaction with the public or poor leadership, disease and coronavirus, and then race relations and racism. All three of those trumped not only the overall economy, the unemployment rate, healthcare, as well as the environment. And that's got to tell you something with regards to where people are going to be casting their ballots. If it's not on some of those issues that the Democratic Party are really leaning towards, except for race relations, then I just don't know where some of those other areas are going to fall in line. But it was just one interesting thing on one poll that posted that environmental change, healthcare, and the economy were all underneath poor leadership, coronavirus, and racism. Now, in my opinion, I think it has to do with when the timing of this poll was actually taken, which was towards the end of June. So, towards the height of the start of the recovery of the pandemic. Now, what people, may not have known, and the three people that I've told this to so far actually didn't know this, Al being one of them, is that the president doesn't always need to win the popular vote. And I know that there's a big debate on the Electoral College versus the popular vote. It tends to be, people only tend to complain about it when their candidate doesn't win. But you can see here, if you notice, Clinton in 1992 only got about 43% of the popular vote. Nixon, who won by a landslide in 1968, only got 43% of the popular vote due to the Electoral College. So you don't have to win the popular vote to become the president of the United States. That's how our laws are written here. And Trump won with 46% of the popular vote in 2016. So it'll be interesting to see where the popular vote, I think it was about 2 to 3 million difference for the Clinton-Trump, according to the latest article that I read. But what I found fascinating about this is that Clinton in 1992 and even in 1996 did not win the popular vote with only 43% of the overall popular vote coming in his way. So one thing, Electoral College is what makes the difference. And if you look here, you can kind of see which states are loyal to their various parties. And what's interesting about this info chart here, this infograph, is it basically shows you out of the last 10 elections, how many times they voted either Republican or Democrat. So Democrat is on the left number, Republican is on the right number. Obviously the dark blue, like states like Hawaii, have gone 9 to Democrats, only 1 to Republican with regards to the last 10 presidential elections. So those gray ones are obviously the ones that are in play, what is known as kind of those swing states. You can see here locally in Nevada, the last 10 elections have been basically split 5 to 5, or Colorado 4 to 6, or New Mexico 6 to 4, very similar. Same thing if you go over to Pennsylvania, 6 to 4 over there. Compare those to places like Mississippi, where all 10 of the last presidential elections have gone to a Republican, or Texas, same thing there. And then you can see as it gets lighter, some of those other states like Florida, only 3 out of the last 10 have gone to Democrats, where 7 out of the last 10 have gone to Republicans. So many states reliably go for the same party, while others are still in play, like New Hampshire, Pennsylvania, even West Virginia, Ohio, Michigan, Iowa, New Mexico, Colorado, and Nevada. And those ones, you can see where the presidents are going, or the presidential candidates are going, where they're spending most of their time in is those swing states. And in our opinion, it's going to come down to just a few states to get to that 270 electoral votes. So if you look back at 2016, here's the numbers from 2016. You can see that Florida, Michigan, Pennsylvania, and Wisconsin went to Trump by less than 1% of the vote, 1% or less. So those are the battleground states you can see off on the far right. Those are Arizona, Maine, Nevada, Minnesota, Florida, Wisconsin, Pennsylvania, New Hampshire, and Michigan. Now, Ohio should be in there. And I think it will be still in play, even though Trump won by about 7% in Ohio. It's going to be interesting, but in our opinion, it's going to come down to those battleground states on the right-hand side. And you can see the margin of victory, whether the Democrats won those states or the Republicans won those states by various colors. In Washington, D.C., Democrats won over 85% of the 85% of the vote. So the election results may be, determined by a handful of states that were really decided by a razor-thin margin last election. You can kind of see where they're polling. This is at the end of September, so these data points are about a month behind. But you can see Florida, Biden has a 1.6% lead, Wisconsin about a 6.7% lead, Pennsylvania, so on and so forth. What's interesting, though, a new poll here in Nevada came out that showed Biden and Trump neck to neck. So these numbers have varied just over this last month, and I think they will continue to vary moving forward. For those of you who don't know or have never been polled, they asked two questions. The first question being, who are you going to vote for? Whether that be the President Trump or Vice President Biden or an independent. The second question that they tend to ask, which isn't publicized in the polling numbers as much, is who do you think will win? And if you look statistically, that second question, which is very rarely publicized, is overwhelmingly more accurate at predicting who the next president of the United States is going to be if you look at it historically. And 56%, according to the most recent Gallup poll, even though Biden leads as I stated, by 6 to 7 points in the Real Clear Politics poll, 56% of those people that were polled think Trump will win. So there's some caveats to all of these things, specifically when it comes to poll numbers. And I think we all learned a valuable lesson on poll numbers in 2016 during that election. But there's two questions that they generally ask: who are you voting for, and who do you think is going to win? And according to the research that we've done, that second question is much more accurate in predicting the election results. Now, here's where the advantage goes to the Democrats. So basically, right out of the gate, it's going to be 222 to 125 in the Electoral College. Biden essentially only needs those guaranteed states plus Pennsylvania, Ohio, and Michigan to reach that 270. So this Electoral College map, just right out the gate, gives a clear advantage. And that's why states like Florida and Georgia and Texas, and even states like Pennsylvania and North Carolina are going to be key battleground states for whoever plans on being the president in 2021. Now, this gets back to that contested election theory that we talked about. We are likely to see a large increase in mail-in voting. It's already started. I know a large number of people have already received them in the mail in Nevada, where they just blanket mailed them out versus absentee ballot voting, where you request it to be sent to you. We even got some at our house. And so I know that mail-in voting is going to be a little bit more prevalent this year. That's very clear, not only due to the pandemic, but kind of how state legislation has really taken shape on some of the voting regulations in each individual state. But complications, as we know, and this is without bias towards politics, the US Postal Service isn't that great. I think there was a meme that went around that basically talked about FedEx package delivery is going to be there at a certain time and then it arrives. Amazon Prime deliveries are already in your house. And then US Postal Service, they basically say what package. So that's kind of a little mailing joke that discusses the inconsistencies of the Postal Service. So there are possibilities that complications can arise. Now, in a contested election, which you can see here, the method of voting in the United States, the in-person voting has slowly deteriorated starting back in 2014 or 2015, and mail-in voting really started to pick up over the last 5 or 6 years in some individual states. And they're kind of meeting at a precipice now, and I don't know which direction they're going to fare after this election, but mail-in voting has a potential to cause delayed election results. The reason is because it may take them a certain amount of time to get in to, if they cast them and posted on election day. So just to put that into perspective, nobody was expecting a contested election in the year 2000 during the Bush v. Gore election, but it happened, and it happened with only one state, which was Florida. Now that contention lasted from November the 3rd to January the 6th. On January the 6th, Gore conceded to Bush, but during that time period, the market dropped about 6%. From November to about mid-December, late December. But if you would have held on during those contentious months, then the market rebounded to an all-time high in January. So my point being that if it happened then with only one state, then it could happen. And if it does, it has a higher potential to be multiple states that are in contention, unless you see a clear victor on election night with the Electoral College, which is what we see right here. If it's a clear landslide in one candidate or the other, where mail-in voting ballots that are left uncounted will not make a difference, even if they're going to obviously count them. But if it's not going to make a significant difference, then that's the only way you're really not going to see a contentious election, just because of how close this election can be from an Electoral College standpoint, depending on just a number of key states. Now, in our opinion, gridlock is good. Right. And the president of the United States obviously has an overwhelming amount of power, but the way that our founding fathers drafted some of the original documents really protected United States citizens from the monarchy type theme, which they fled from England. And what I mean by that is the different branches of government, and in particular, the difference between the White House and Congress. And what we have this election is also the potential for a blue wave, is what they've talked about, which basically means that Democrats will sweep the House, the Senate, as well as the presidency. Well, we don't want to get in that politic, but what we will say is that US equity returns by party control are overwhelmingly better when you have a split White House and Congress. And the reason is because you lower the chances of massive policy shifts one way or the other that affects not only corporations and the stock market, but also individuals and their spending habits based off of specific policies. So you can see when there's a clear sweep under a presidential election year, the average rate of return is only about 9%, which still isn't bad. But during a split, you have about a 400 basis points increase to about 12% a year during a split government. And that tends to be a little bit better for stocks. So our prediction is that the Senate's going to basically stay the same under the Republican control, and the House will remain the same under Democratic control. You can see here, likely Democrat votes of about 48 are likely Democratic seats, likely Republicans 47, and about 5 of those being toss-ups, which we see a little bit of a favor in the Republican Party. And then obviously the Democrats are going to keep the House with a 221-186 lead, with only about 28 of them of toss-up, with a decent majority of those going to the Democrats. And you know, when we look at those sweeps, the likelihood of a Democratic sweep has really declined in the eyes of betting on the market, but it's still pretty close. It's about 48% chance of a Democratic sweep. So not quite 50-50, but it is something to be cautious about. Now, with regards to a blue wave and some of those implications of what can happen, we're going to look at some of the proposed changes of the Biden administration, or what they're going to propose during their administration, and see how that can really impact. But if there is a blue wave where you have a House and a Senate, there is a higher likelihood, that's all I'm saying, there's a higher likelihood of a tax increase passing. And from a tax increase, what I mean is capital gains. So the Biden administration wants to increase capital gains from 23.8% to 39.6%. And you may say, Andrew, that's only 16 points, but 16 divided by 23 is a 69 or almost a 70% increase in capital gains tax. So what capital gains tax is, if you only have qualified retirement plans, it doesn't make a significant difference in your lives. But for those individuals that invest with before tax dollars, where they're paying taxes as they accumulate, capital gains is triggered if we sell an investment after 12 months and a day. So if we sell it after 12 months, essentially, then we get to pay tax at capital gains rate versus ordinary income. So ordinary income is your basic tax bracket, which tends to be higher than that 20% unless you're a low income earner. Or sometimes retired individuals that have a sustainable amount of income don't get into those higher brackets. But we'll remove those from this plate. So there could be selling in November and December that, in our opinion, could be short-lived if there is a blue wave. Why? Because that increases chances that tax planning increases could take effect, which could increase capital gains tax from 23.8 to 39.6, which is a 70% increase. And that would have the effects to take, or that would have the ability to take effect potentially in 2021. So what would people want to do with the last, 30 days or so of 2020? Specifically, if they're sitting on large capital gains, they'd rather pay 23.8 versus 39.6. That's a clear cut strategy. So that's one blue wave. The second likelihood under a blue wave is a likely higher crackdown of fossil fuels, which could be bad for energy stocks, which we'll get into here in just a second. So there are priorities, in our opinion, that fall along party lines. So, growing consensus, in our opinion, in both parties is that fiscal stimulus, either through lower taxes or higher spending, which result in larger deficits, is acceptable. And in our opinion, to them, it seems even desirable. So we believe that the entire stock market could benefit more than what many expect through larger deficit spending. So you can see on the right, lower taxes, American first, tariffs as weapons, border control, pro-life, private sector healthcare, reduced regulations, all under the Republican Party. Under the Democratic Party, higher taxes, coalitions to work with allies, more free borders, pro-choice, government healthcare, environmental and worker protection. All of those things, what they have in common is deficit spending. We think deficit spending paired with, which is stimulus essentially, paired with a potential vaccine are positive for the markets in 2020, regardless of who the president is. So one important place of agreement, like I said, is deficit spending. And regardless of the party, the budget doesn't matter, looking at what they're projecting out. And that's only positive because, at least currently, interest rate and inflations are still low. And that makes deficit spending attractive. Why? Because they can finance 10 years worth of debt at only 73 basis points, so less than 1%. So we do think that the entire market, at least in the short term, will benefit from that deficit spending. It's the longer term aspects on the national debt, what that will do from a country standpoint when you stretch that, that time frame out, let's say 10, 15, or 20 years. But deficit spending is something that we see as a potential positive based off of statistics. So you can see on the left, small deficits only give you a real rate of return in the S&P 500 of about 6.3%. Larger deficits, that means stimulus for the economy, generally speaking, give you a rate of return of closer to 15. So almost double the rate of return of smaller deficits. This goes back to 1946. So here's a good example of deficit spending as an aggregate of the Biden proposal. On the left side, you see the revenues collected. On the right side, you see the spending. Now, these are trillions of dollars. And it's unfortunate, the reality that people don't understand how big $1 trillion is. And we are now just throwing these numbers out like it means nothing. That number is so large, we can't even fathom the amount of debt that it would accumulate to get to that point of even just $1 trillion of spending, right? I mean, Apple is almost a $2 trillion company. So these numbers that with the T in front of it are starting to become more and more prevalent. But if you look at the left, where they're going to raise corporate taxes to, or at least in this proposal, raise corporate taxes to 28%, that's going to generate about $1.3 trillion of taxes. They're going to apply a 12.4% payroll tax above 400,000. That's going to generate 962 billion. So on and so forth. Also, I'm happy to send this out to anybody that wants a copy of this. Just make sure you email us and we'll make sure we send out a copy of all of this to you. But you can see here, there's a $3 trillion deficit between what the proposed spending plan is. Now, what this doesn't include on the right, what you'll see there is racial equity plan. So that would be like reparations. They haven't said anything as far as a specific number of what they want to spend on that. They're under the Biden proposal. But still, there's a $3 trillion deficit spending difference between what they're planning on spending and what the revenues are going to be collected under the current plan. Now, obviously, all of this can change. And as soon as it touches Congress's hands, we know it will change. This is just what they're proposing. But the policies along party lines, we still think, even if you have a split Congress, that there can be some policies that can be done. Now, even though there's two parties and have very different ideologies, there are areas, like I said, that investors should be able to recognize. So on the right side, with the Republicans, they want middle-class tax cut, lower regulation, and increased defense spending. On the left side, they want higher income tax, public health care option. They want to eliminate carbon emissions, raise the minimum wage, have enforced gun control, and criminal justice reform. Where we see that they could meet is on lower drug costs, onshoring, and spending on infrastructure. So those are areas that we want to focus on regardless of who the president is moving forward. And in our view, a Democratic government will likely benefit alternative energy and infrastructure related companies and hurt those in traditional energy as well as health insurance and banking. So if we have a Democratic House, Senate, and presidency, we should still be bullish on alternative energy, building products, healthcare equipment. Cannabis could be one alternative. China exposed stocks. Why? Because they've been beaten up pretty harshly under the Trump tariffs. And forest products, because there should be some increased spending on forest maintenance, even though it's not promised. But we should be bearish on consumer finance. Why? Because of the increased taxes that individuals are going to have to pay. Exploration and production, because they want some form of the Green New Deal. Integrated oil and gas, we should be bearish on. Banks, they will most likely roll back or implement a further, like the Glass-Steagall Act, that could come into play. Pharma and biotech, where they want to tax the profits. So if you look here, on the bottom left-hand side, they want to profit taxes on pharma companies. So if you make a profit as a pharmaceutical company, they want to tax that at a higher rate. If you look at the retail and restaurants, depending on how much of a pinch the underlying consumer has from increased taxes or even increased taxes on corporations, right? So a lot of people think that, hey, it's okay if Apple pays, more in taxes. Well, it's not just Apple that's a corporation. Whalen Financial is a corporation. A lot of our clients own corporations. So they may feel a pinch, which may mean that if they're paying more to Uncle Sam, that means less to do as far as travel and leisure and going to Costco or going to Walmart. So we want to be careful in some areas, but also we're still bullish because we think that the market, no pun intended, trumps any kind of presidency over a market cycle. Now, and what one of the biggest things that I look at as far as an indicator, and it came from LPL Financial, one of the chief economists, and he pointed this out, and he basically looked at a statistic that went back to 1984 with 100% accuracy, and went back 104 years to Woodrow Wilson with an 87% accuracy. And what this looks at is basically the 3 months going into the election. And if those 3 months are positive, so August, September, and October, if the collective performance of the S&P 500 is positive during those 3 months, the incumbent party tends to win, either 100% of the time since 1984 or 87% of the time since 1916. If those 3 months, August, September, and October, are negative for the S&P 500 collectively, then the incumbent party tends to lose. So in August, we were up 7%. In September, we were down 3.9. And so far in October, even after today's modest pullback, we're up 1.9%. So the collective total between those three numbers are about 5%. So if this statistic that's been 100% accurate since 1984 and 87% accurate since 1916 is going to be wrong, then the market needs to pull back about a little over 5% from now over the next 2 weeks. If it stays consistently the same of where we're at, that is an indication, according to this model prediction, that the current incumbent president, which is President Trump, is going to be reelected for a second term. Now, we believe that certain groups may win and lose regardless of who's in power in the stock market. And this is what we call investing at the intersection, right? Where policies can converge and still have the ability to produce positive market outcomes despite who sits in the Oval Office. So potential winners on the Democratic side are alternative energy, cannabis, electric vehicles. For Republicans, traditional energy, defense, as well as banks. But right in the middle, we still see small and mid-cap growth companies, still a positive space to be in because they don't get heavily regulated as much as some of those larger corporations do. Cybersecurity as well as infrastructure are something that we think are going to be predominantly positive regardless of who sits in the Oval Office. Potential losers are if a Democrat wins, for-profit education and prisons, student lenders, restaurants, and for Republican potential losers, bond-like equities or large multinationals, because it's that America first mentality. But regardless, we still think pharma is going to be a potential loser regardless of who's in the White House, just because of the regulations that are put on them. And my point of this whole conversation is, because I know we've been getting questions at the office, is, despite who's going to be president, investing in politics very, very rarely works. And I use the example of President Obama and President Trump, just because it's the most recent. You may not have agreed with the policies of President Obama, but if you bet against the stock market over his 8 years, you would have been wrong. Plain and simple. Same for President Trump. You may not agree with his rhetoric or delivery methods or even his policies, but if you would have bet against the stock market from January of 2017 to today, you would have been wrong. And that's our theory, that innovation, companies, individual entrepreneurs that represent large corporations will surpass any kind of presidency or any kind of downturn or any kind of economic calamity or any kind of pandemic. But it's that volatility that really drives people away from the market. So I always talk about volatility as the dragon that guards the golden chest. And for those of you who've never seen Lord of the Rings or read The Hobbit, there's a dragon character in there that guards a large amount of gold. And that is the theory that we have at our firm of what volatility presents. There is one certainty to investing, is that there's going to be volatile times. But volatility is the dragon that guards the treasure. And that treasure is innovation in companies that produce potentially large growth rates over certain periods of time. And investing in innovation easily beats an America First portfolio or only Republicans or only Democrats, and because it suggests that innovation and fundamentals are more important than politics. And we believe that there are benefits in investing in those secular growth companies, irrespective of political outcomes, even though there are going to be times, specifically if there's a contentious election, where it can be uncomfortable to hold some of those names. But like I said, if you would have bet against the market from 2008 to 2016, you would have been wrong, regardless of policy. And the same thing for President Trump. And I can name a number of presidencies going back to history. And our core principle being that innovation surpasses any kind of presidency or any kind of downturn. And this is proof. So this is innovative companies have outperformed over the past decade by a tune of almost 900 basis points of cumulative excess returns. And this goes back over the last 10 years. And this November, don't chase it, right? Don't choose. Don't invest your portfolio based off of who you want to win. Invest it based off of what those companies are actually doing. Are companies continuously reinvesting their free cash flow in research and development to make their product or service better? Are those companies continuously expanding their economic moat to make their products and services continuously more competitive? Are those board of directors really focusing on bottom line earnings to drive top line results? And if the answer is yes, then what you have to understand is that the market will continue to always do what the market's going to do, but allowing politics to get mixed with investing has never been a good investment strategy. So this last chart that I'm going to leave you with today is the growth of $10,000 in the S&P 500 based on the presidential party. So if you only invested when Republicans won, you're on the bottom left. If you only invested when Democrats won, you're in the middle. But if you would have just bought it and held on to it during that period of time, this goes back to 1968, you can see a huge cumulative difference in portfolio value. And when we deal with clients, we can't just deal with the next 4 years. We can't just deal with the next 8 years. You know, the majority of our clients are going to be retired for the next 20 to 30 years. And that's a multitude of presidents. That's a multitude of changes of policy. So we still continuously believe that despite what happens in the economy and the markets, as long as we're properly allocated, continuously investing in innovative companies will far surpass any presidency or presidential election. So I hope everybody enjoyed today. Thanks for taking the time. I really do want to say thank you for taking time out of your day. If you have any questions, email me or give us a call, and I'd be happy to send out the presentation if you'd like to look at the charts a little bit more in detail. Either shoot myself an email or Jim an email, or you can just email us down there at info@whalenfinancial.com. All right, everybody, have a great day. Thanks.